you ever seen those films where a trader, maybe glued to 6 different screens, makes a genius call on a stock and earns a fortune overnight? It looks exciting, right? That idea that you could just find the next big thing. But what if I told you that trying to be that person is one of the biggest and most stressful mistakes that most of us can make with our money? Today we're going to talk about why I don't pick individual stocks, and more importantly, why you probably shouldn't either. This isn't about crushing dreams. It's about giving you permission to ignore all that noise and follow a much simpler and honestly a much more reliable path to building your wealth. At its core, you have to remember that for every investor who outperforms the market average, another investor has to underperform it. For you to win, somebody else has to lose. And the deck is already stacked against you because of one simple thing: costs. Active investing, researching, buying, and selling individual stocks comes with higher fees that create a constant drag on your returns. This means that you have to perform even better than the pros just to keep up with market value. And the data on that is absolutely shocking. A recent report from S&P showed that over a 10-year period, a staggering 93% of global active funds failed to outperform their market benchmark. 93%! These are the highly paid experts with teams of researchers, and the vast majority of them can't consistently win this game. So if trying to be a stock-picking genius is off the table, what's the alternative? You don't have to beat the market, you just have to use the market. And the best way to do that is with something beautifully simple: an index fund. An index fund is like buying a massive fruit basket instead of trying to pick the single best apple. You're buying a tiny piece of thousands of the biggest companies all at once. For example, in my own portfolios, I hold funds like the Vanguard FTSE Global All Cap Index Fund and the HSBC FTSE All World Index Fund. They all do a very similar job, investing my money across thousands of companies worldwide so I can participate in broad global market growth. And these funds have already made me some very handsome returns, if I do say so myself. If you want to see exactly why I chose those and get a full walkthrough of setting it all up, I explain my entire investment strategy in a 10-minute video on the channel. I'll make sure that's linked for you in the description of this video. This approach is diversified, low cost, and lets you harness the growth of the entire global economy over time. The less you fiddle with your investments, the better you'll probably do. This reminds me of a concept from Stephen Bartlett's book, Happy Sexy Millionaire, where he talks about the importance of focus. If you get distracted by everything else, you lose energy and dilute your results. It's the same with investing. If your one goal is long-term growth, then focusing on a simple strategy, like consistently buying an index fund, is far more powerful than getting distracted by the daily noise. This focus allows the real magic to happen: compounding. Let's look at what that actually means. Historically, global funds have averaged around 10% per year over the last 20 years or so. Past performance doesn't guarantee future results, but let's use that as a hypothetical example. Imagine you start with just £1,000 and manage to invest a further £250 a month. After 10 years, you would have contributed £31,000 in total. And thanks to that 10% average growth, your pot would be worth around £53,000. That's over £20,000 of pure growth from the market. Stick with it for 20 years, you'd have put in £61,000. Your pot could have grown to a massive 190k. And after 30 years, your £91,000 of contributions could become a life-changing sum of £537,000. To really bring this to life, let me tell you a quick story. Imagine two friends, Alex and Pete. They both get a £10,000 inheritance. Alex is ambitious and wants to beat the market. He puts his £10,000 into an active fund. Now, for the workings I'll show on screen, this is all hypothetical. We'll assume his fund charged higher fees at around 1% a year in total, and like most active funds, it slightly underperformed the market, getting a 9% return before those fees were taken off. After a decade of stress and watching the fund trade in and out of stocks, his £10,000 has only grown to about £21,600. Pete, on the other hand, is more laid back. He puts his £10,000 into one low-cost global index fund. For his workings, we'll assume he just gets the market's 10% average return, minus tiny fees of about 0.15% a year just for the fund itself. And then he leaves it alone. After 10 years with no stress, his initial $10,000 has turned into roughly £25,600. Pete is now £4,000 better off. He won by simply choosing not to play the loser's game. The takeaway from that story is simple. Be like Pete. Forget the idea that you need to be a genius to invest successfully. I also probably don't need to tell you this, but Alex's outcome could have been much worse. If he had gone all in on one stock pick, he quite possibly could have lost most or even all of his money. After all, the average lifespan among the top 500 listed companies in the US is only around 15 years. Knowing that, I'd hate to be this guy who's holding all of his investments on Tesla stocks. I can only imagine the stress that is putting him through. The smart path is to focus on what you can control. You can control how much you save, and you can control your strategy. By choosing a broad, diversified index fund, you are choosing a strategy that is proven, low stress, and perfectly designed for long-term success. If this approach sounds like a weight off your shoulders and you're thinking, okay, I get it, but how do I actually do it? Then I've got something for you. I'm creating a step-by-step investing mini course designed to take you from zero to your first investment in under an hour. It's no jargon, no nonsense, just a practical guide to getting started. The first 50 people who sign up to my email newsletter will get access to it completely free. The link is right there in the description. If you have any questions, please drop them in the comments below. I always love hearing from you. Subscribe if you'd like to see more, and I'll see you in the next one.